On July 31st of 2023, the Yellow Corporation filed for bankruptcy, saying there was no way they could possibly pay their $400 million debt payment for next year. For context, their net income for this year was about $21 million. Now, if you're like most people, you'd probably never even heard about the Yellow Trucking Company until they declared for bankruptcy. But even though you've never heard of them, they significantly impact all of our lives. They are why so many things are at Walmart and Home Depot on the shelves like they are. So, since you clicked on this video, I bet you, like me, are wondering why they went bankrupt. Well, you're in luck, because in this video, we'll answer that very question. Now, if you want to understand why Yellow went bankrupt, we'll need to dive a little bit deeper than just, oh, they had way too much debt, or oh, the unions killed them. So, to understand why Yellow went bankrupt, we'll first go through a brief history of Yellow, just so you can kind of understand what their business is, because it's a different kind of trucking company than a company like UPS or FedEx. And by going through Yellow's history, we'll be able to see their poor mistakes build up, culminating in the company's collapse in 2023. And at the end, we're going to talk about the strategic mistakes that Yellow made and what they could have actually done to do better. The cool thing about the root cause of Yellow's bankruptcy is that we can take some critical lessons from it to improve our own lives. Whether you're a student, entrepreneur, business owner, or regular worker, understanding the strategic business reasons of why Yellow went bankrupt could help you run your business better or solve problems you face in work on a day-to-day basis. But before we jump in, I'd really appreciate your help. Making these videos takes a ton of work, and as of right now, I haven't made a penny off of all the researching, filming, and editing I've done to make educational, non-clickbaity business content for YouTube. So if you like learning about business and you want to help a brother out, consider clicking that little like button or maybe subscribing. This way, YouTube knows that this is a good video and it'll suggest it to more people. Or you can always wait till the end of the video to like and subscribe then as well. That's totally okay too. Now, let's get into why Yellow went bankrupt. Even though its logo looks a bit more orange than yellow to me, Yellow's roots stretch back to 1906 when Grover Cleveland Harrell, not the president, founded the Yellow Cab Company in Oklahoma City. Armed with just a horse-drawn carriage and a team of horses, he soon scaled up and bought a Model T Ford. The novelty of the automobile in the 1910s proved irresistible to the public, who paid a premium for the privilege of riding in one. This premium offering is a fascinating point because Grover's business model here differs significantly from what his company would become a century later. When World War I ended, Grover expanded his business, and in 1918, he painted one of his cabs yellow, which really helped it stand out in the sea of bland-colored taxis. The paint trick was extraordinarily successful, and Grover painted his entire fleet yellow shortly afterward, leading to a surge in business. Grover's older brother, A.J. Harrell, joined him in Oklahoma City after a successful stint running a horse and mule business during the war. The brothers then formed a partnership and expanded the company. In 1929, following the oil boom in Oklahoma City, the brothers saw an opportunity to serve small manufacturers by establishing Yellow Transit Freight Lines. This company offered transportation services for people who wanted something faster than a traditional freight rail, but couldn't afford the extremely expensive express services. Their business did really well even during the Great Depression and World War II. A couple of years later, the brothers split the company up, with Grover taking the taxi part and AJ taking the freight part. Yellow remained a regional enterprise until 1952, when a group of investors purchased the freight company. Under their stewardship, Yellow innovated by moving smaller freight shipments on pallets into trailer loads. This idea created a new segment of the market, which we now call LTLs, or less than truckloads. This innovation allowed Yellow to access a new market. The new market was people who wanted to ship anything less than a full truckload, but didn't want to pay for the whole truckload. Now people could send smaller things, even down to a single pallet, and could save a ton of money because they didn't have to rent out the whole truck. Yellow grew a lot servicing this niche of the trucking industry. And now that you understand Yellow's beginnings, let's jump ahead about 40-something years to the beginning of their fall. In the early 2000s, Yellow leadership wanted to grow the company, and rather than doing so organically, in 2003 they bought one of their competitors, the Roadway Corporation, for about $1.1 billion. And 2 years later leveraged themselves, aka went into debt, remember that, it'll be important later, and bought another massive trucking company called USF Trucking for $1.5 billion. These two purchases in themselves aren't necessarily bad, but it's what they did afterward, or more so failed to do afterward, that definitely laid the foundation for their demise. The big mistake here is that they did not integrate the companies they bought into their operations. And to understand why that's such a big mistake, we need to understand economies of scale. Economies of scale refer to the cost advantage that a business can achieve as it expands its operations. The idea here is that the cost of producing each unit, whether it be a doodad or delivered pallet, decreases as the volume increases. This is because you can spread out fixed costs over a larger number of units and gain operational efficiencies with larger production volume. In the case of the trucking industry, there are 4 forms of economies of scale. The first is purchasing economies. A large trucking company can buy trucks, fuel, tires, and other supplies in bulk, oftentimes securing a better price per unit than a smaller company could. This is because the supplier can also benefit from selling larger quantities at once, reducing their own per unit costs. Second is operational economies. Larger trucking companies can oftentimes streamline their operations in a way that smaller companies just can't. For instance, they can optimize their routes more effectively, minimizing the time that trucks can run empty or idle. This results in a lower cost per mile. Thirdly, technological economies. With a larger fleet, a trucking company oftentimes invests in advanced technology systems such as route optimization software, real-time tracking, and fuel consumption monitoring systems. These technologies can significantly improve the efficiency of the operation, reducing the cost per unit. And fourth, financial economies. A larger trucking company might have an easier access to finance at lower interest rates, as they pose less risks to banks or investors than smaller, less proven companies. This can lower their cost of capital, further reducing their overall costs. So the whole purpose of buying other companies like Yellow did is to benefit from economies of scale, right? It seems like a no-brainer to integrate them, but rather than integrating the companies, they have them operate side by side. This is very weird. This lack of integration would be like if Ford and Lincoln refused to share engineering tech or parts designs, even though they're both part of the same Ford Motor Company. So why didn't they integrate? Maybe they thought, integrating these businesses is really expensive. Let's just save up some money for the next couple of years and then we'll do it. Or maybe the leadership just thought, hey, this sounds really hard and I don't really want to do it. Let's leave it to the next guy. Either way, it was the wrong decision to not integrate, as only a couple of years later, the Great Recession hit. And by the end of 2009, Yellow was in a really precarious situation. The company had to manage large debt payments, pacify its union workforce, which had already accepted wage reductions in the face of the 2008 financial crisis, and win back freight customers as competitors had undercut Yellow's prices. And remember, one of Yellow's selling features was its low cost, so a lot of their customers were very willing to jump ship if the price was right. After several months of negotiations and credit agreement modifications, Yellow managed to negotiate a $470 million debt for equity deal in the closing hours of 2009, enabling it to defer interest and fee payments until 2010, securing $160 million in liquidity and avoiding bankruptcy. Over the next decade, Yellow tried to improve its financial situation, but most of its solutions did not change the business's core competencies. Instead, they only offered momentary relief, a lot like treating the symptoms of an illness rather than treating the actual illness itself. Some of these attempts at saving the company include divesting non-LTL offerings, aka just focusing on Yellow's primary service, selling and leasing back facilities. This is a really easy way to put short-term cash into your bank account, but bad for long-term profitability, and reducing capital expenditure on equipment, or in other words, not investing in their fleet of trucks and their technology. As you can probably guess, continual neglect of fleet and terminal upgrades resulted in higher operating costs and service inadequacies, which led to a vicious cycle. They make less money, which meant that they couldn't invest in their fleet, which meant that their service suffered, which meant that they made less money, which meant that they didn't have as much money to invest in their fleet. Because of this cycle, Yellow had to become even more of a low-cost carrier to compensate for its low service scores, which left it barely able to cover its own operating expenses in most quarters. This became an even bigger problem when COVID-19 hit and Yellow's revenue completely dried up. Somehow, Yellow got a $700 million COVID-19 relief fund from the government. The government's official rationale here was that giving Yellow the loan was necessary for national security, as Yellow provides a lot of shipping services to the military. Despite this rationale, though, the Treasury's decision to issue the loan in July of 2020 has been heavily scrutinized, with a recent oversight commission finding many flaws in the decision-making process. Some people surmise that the Trump administration gave Yellow a cushy deal because Yellow is backed by Apollo Global Management, which is a private equity firm that seems to have its fingers in everything, but more importantly has really close ties to members of the Trump White House. Now, I don't know if that's true, but the most important thing is what they actually did with the money, because if they used it well and Yellow was killing it today, no one would be complaining, right? So let's talk about how they actually spent the money. Hint, it wasn't maybe the best use of their funds. The first portion of the loan, about $300 million, was employed to cover immediate cash requirements such as delayed healthcare and pension plan contributions, lease payments, and interest payments on other debts. The second portion, about $400 million, was utilized for buying tractors and trailers. Yellow claimed this huge capital expenditure would save about $10,000 to $12,000 per tractor annually, which would help it eventually become financially stable. But most people saw this as just too little too late. Yellow replaced about 2,400 tractors, or about 17% of his fleet, and 3,600 trailers, and bought about 600 rail containers. But despite the upgrades, the new government loan increased the company's total outstanding debt to nearly $1.6 billion, up from about $880 million at the end of Q1 of 2020. Despite the capital improvements, the additional debt made it even harder for Yellow to make the operational changes it needed to make in order to become competitive again. Over the next couple of years, Yellow burned through its cash as it struggled to become profitable. As you can see from this graph, Yellow hardly ever poked through to a net positive profit margin. And sure, the shipping industry in general doesn't have the largest profit margins in the world. Still, if you compare Yellow to its two competitors in the LTL space of ABF Freight and T-Force, they have profit margins at about 5% and 9% respectively. Remember, Yellow is supposed to be paying around an estimated $180 million a year just on debt payments, and it can barely eke out $21 million in profit despite bringing in $5.2 billion in revenue. Now, in 2023, 20 years after they bought Roadway, Yellow decided that it was finally time to combine their different operations. But remember how I said earlier that combining operations is expensive and complicated? That's because it is, and Yellow just doesn't have the cash to do it. And they can't take out any more loans, so they decided to try and get their workers to do more dock work, among other things, to increase their workload. The Teamsters Union did not like this and said that Yellow did not have the authority under their contract to change these job responsibilities. It said that its member employees at Yellow had already given billions in the form of wage, benefits, and pension concessions in the past, and that it would not bail out the company again. So Yellow did the only reasonable thing and decided to sue the Teamsters, the people that they were trying to get help from, saying that the Teamsters couldn't interfere that way with their business, right? That's totally logical. I'm not going to go too in depth here, but based on my reading, the Teamsters seem to have a pretty strong position to argue from. Finally, the straw that really broke the camel's back was when Yellow missed paying benefits payments for health, welfare, and pension funds for their workers, which contractually allowed the Teamsters to issue a strike notice saying that they were going to go on strike. This strike notice caused Yellow customers, many of whom were already reducing the amount of freight they shipped with Yellow, to completely stop using Yellow. And shortly thereafter, Yellow declared it would have to file for Chapter 11 bankruptcy and sell off its inventory of trucks and equipment to try to pay off its debts. According to their bankruptcy filing, the company estimated assets to be about $2.15 billion and liabilities to be about $2.59 billion. About 30,000 people lose their jobs, but I did promise there'd be a lesson in this whole thing, right? A bright side. So what is the lesson that we can all apply to our own lives from Yellow's mess? In my opinion, there are two lessons that we can learn from Yellow's failures. The first is, if you're going to take on debt, make sure it actually helps you make money. Don't take out big loans for cars that won't pay themselves back. Don't take out debt to buy new desks if the old ones work just fine. Don't buy stuff just to keep up with the Joneses. And the second big lesson is, don't expand just for expansion's sake. Ask yourself, what would expanding your business actually do? Would it make you more money? What's the likelihood of it making you more money? Would it be better to grow in a year when it won't be as big of a risk? This can also all apply to your personal finances with buying a house, for example. Stretching your budget for that bigger house isn't always the best move, and sometimes it's better to play it a little bit safer. Now, I'd love to hear what you think. What do you think Yellow could have done to be more successful? Was Yellow's fate sealed from that leveraged purchase in 2005? Or could they have done something along the way to fix it? Thank you guys so much for watching. Don't forget to subscribe, and I'll see you guys next time.